So one of the core areas of our research is profitable growing small cap stocks. We just completed a webinar on how and where to find 10x stocks, or essentially great long-term growth stocks. The data tells us that profitable microcap businesses are fertile ground for identifying potential 10x stocks. So one of the areas we explored in the webinar was how to gain meaningful exposure to profitable 10x micro and small cap stocks. And when I say this, I stress the word meaningful because we want to design a portfolio that is well positioned to actually benefit from holding a great capital compounding stock. In theory, if you hold an index ETF on the entire Canadian market, for example, you have exposure to every stock. So you are exposed to the next great small cap or 10x stock. But if it is 1/10 of 1% of your entire portfolio, even if it doubles, triples, or runs 10x, which is the best case scenario, one of the best case scenarios, it still has little impact on your overall returns. So one of the avenues we explored was by gaining exposure to these stocks was by investing in a bank-run small cap mutual fund. Why? Because in theory, owning a small cap fund to gain exposure to small cap stocks, that makes sense, does it not? And most big banks have a small cap fund, just like when you need something on the internet, you know there is an app for that in the financial world. The big banks have created a fund for that. One thing they're great at doing, creating products that are saleable to investors. Now let's look at one of the big banks' flagship small caps funds to see how well you gain exposure to quality small cap stocks and potentially benefit from finding the next 10x stock here. But first, I'm just going to look at the definition of a big bank fund, or the definition of a small cap stock. Generally, market participants consider Canadian small caps to have a market cap of 800 million or less. To be included in a small cap fund, most stocks should hold market caps of under 1 billion. All right, let's look at that snapshot of that fund. Now, this is the TD Small Cap Equity Fund. Again, I'm not picking on TD today. All the big banks have a similar form of this fund. So if we look here, just based on the holdings alone, just the number of holdings, there's so many problems with this fund. It's far too many stocks. In the webinar we showed participants that you can have an optimally diversified portfolio with just 25 stocks. In fact, it's less than 25. This fund has 116 small cap stocks, or I'll quote that, small cap stocks. Far too many stocks to gain exposure to a segment. Far too many. It's unnecessary. I allude to this just a second ago. The real problem is that constructing a fund with this many stocks, even if one of the stocks happens to be a Boyd or a Hammond Power, these are small caps from our coverage that have gained 10,000 and over 20,000% respectively. Its impact on the fund is neutered, as is one of 116 stocks in this small cap fund. So even if the stock performs incredibly well, we talked about this gaining 100%, that would likely add less than 1% to this fund. Of course, if you're going with a big bank advisor, that would be one of 10 plus funds that you may own. So the gain in your portfolio, if you owned a truly great 10x stock via this fund, would be likely less than 0.1%. If you're not, again, you're not gaining meaningful exposure to a 10x stock through this fund. The construction of the fund alone is enough to make it a complete non-starter as a means to participate in great small cap growth stocks. But the more you explore this small cap fund and what it's actually invested in, you find significant number of its top 10 holdings are definitely not small caps. So that definition I gave you in terms of small caps in Canada, that they are market caps of 800 million or less. Well, we see here, again, to be included in most small cap funds, you should have a market cap of less than 1 billion. There are some small exceptions due to performance gains, but on average, it should be in that range. Again, look at this fund. The top 10 holdings. Celestica has a market cap of 7.88 billion, which is nearly 10 times the upper limit of what is considered a small cap in Canada. The second largest holding, Ivanhoe Mines, has a market cap of 25.47 billion, nearly 31 times larger than what is considered a small cap in Canada. Number 3, ARC has a market cap of 13.56 billion. Fairfax, 38.42 billion. Again, I think you see where I'm going. You can see that on the screen here. In fact, not a single stock in the top 10 holdings of this small cap fund is actually, by the most generous definitions of a small cap stock. Now, I point out the fact that there are 0 points, as I point this out, 0 small caps in this small cap fund. I kind of feel like Jeff Goldblum in the first Jurassic Park, where he's touring Jurassic Park, and the first 3 exhibits show no dinosaurs, and he turns to the camera and he says, are there going to be any dinosaurs on your dinosaur tour? And I would say, are there going to be any small caps in your actual small cap fund? Not only are there no small caps in the top 10 holdings, nearly half of these companies would qualify as US large caps. They're not even in the ballpark of what we'd consider a Canadian small cap. So the more you look at this fund, which is marketed to Canadian investors as a small cap fund, the more silly the entire exercise becomes. It helps big banks sell exposure to a segment of the market which is saleable because small caps historically outperform. But as you can see, if you want to actually participate where most 10X stocks are found, you should not buy this fund or other big bank funds that mirror it. Now, I've been researching and recommending Canadian small cap stocks for a quarter century. There are typically never more than 25, 20 stocks at any given time that we could buy. Most of the time, it is far less. Think 5 to 10 stocks in this segment that have high quality and trade at reasonable price. But somehow, all of these funds manage to hold and find and hold 100 plus great small caps to be invested in all at one time. It's a poorly thought out, poorly constructed from a return perspective. They're just engineered by the fund company to sell an idea. That idea, small caps, good, and make money off that idea. Not designed to pick great companies and try to outperform. If you want to mirror the small cap index, just buy a low cost small cap ETF like the iShares Russell 2000 ETF, for example. If you want to use small caps as part of the growth area of your portfolio, buy them individually and use good research. That would be my take. Take control of your portfolio. If you want to beat the market by incorporating great long-term capital compounding small cap stocks, you cannot be the market. You cannot own 116 or hundreds of these individual companies. You want to create your own simple equity portfolio. Build with a mix that looks more like this. As you can see here, 5 to 8 stocks. If you're having 25 stocks in the portfolio, 5 to 8 from core Canadian small cap stocks. In terms of if you're using our research, 5 to 8 from core Canadian dividend stocks, 5 to 8 from US growth or small caps, and 5 to 8 from US core dividend and dividend stocks. All right, that's my soapbox for today.
Yeah, I mean, it's quite eye-opening. I remember when you initially uncovered that ETF, and we're just like, these poor people that are invested in it, thinking that they're in a small cap fund when it couldn't be farther from the truth. It's quite, eye-opening, I guess, to the average Joe,
Like, I knew this went on, but when you, again, pick a random fund, like I just picked, okay, we'll go to TD, one of the largest funds in Canada in this space, and then you look at the holdings, and I was surprised to see not a single in the top 10 would even, qualify as a small cap in Canada. And then, like, to hold like the Fairfaxes of the world, like your $38 billion, that is a US large cap fund that is in this small cap. It doesn't make a lot of sense to me. Like, I get they have a large amount of funds that they're trying to deploy, but if you cannot deploy them, then you have to, stop the fund. You can't hold that much within the fund. You can't have that much in terms of assets under management if that is the reason you can't deploy in small cap funds or stocks.
Yeah. And that was the first one that you...
Yeah, that's just the first one I came across. I didn't have to do a lot of research to find one that fit any narrative or anything like that. Yeah.
50 of the top small cap are thematic funds.
They are, a lot of them have huge issues, particularly, again, the big banks. But it is strange to call this.
This is also a good lesson as well, why, at least some level of financial literacy is important, even if you are going to use a financial advisor, because you need to be able to check what your financial advisor or your asset managers are doing. You're paying them fees. You want to make sure that they're doing what they tell you that they're doing. And you can't know that unless you have some basic level of financial literacy.
No, agreed. And you could do a little bit of quick research. You could say, what is a small cap? And Google will bring that up for you. And you could say, okay, let's look at a couple of these companies. Like, again, all I did was look at the top 10 holdings. They're right on their website there. Couldn't find, obviously, all they have really is the top 10 holdings just displayed there. You can look and find all of them as well. But I mean, you can, the top 10 holdings and all, not a single one. I mean, most of them, the other thing is if they were on the edge of being a small cap stock, but I mean, most of them are not even close. Like when you're talking about market caps of, most of them 10 billion plus, and 25 billion with Ivanhoe, 20 billion Tourmaline, and 38 billion in Fairfax. They're not even masquerading on the edges of being a small cap stock. These are U.S. large cap stocks by definition, most of them, and being in a small cap fund just seems really out of place. And again, if the reason was they bought them 10 years ago in this fund and they went up so much that they were a huge part of the portfolio, but again, then you look at what percentage of the overall fund they now rank as, and you look at Fairfax, it's just 2.5. Well, I guess they could say we've been trimming. Once it went above 2.5 or 2, we trimmed it off. But again, you're not. The point is to gain great exposure to great capital compounding stocks. And if you just keep trimming the best winners, you're not going to gain the best exposure to those companies anyway. So, anyway, I don't believe, again, that fund probably got too large, and they're just we can't invest in. It says they also invest in mid caps, but again, these aren't mid caps either, basically, in most cases, right? So, all right, we'll move on.
I've just been quickly Googling some of the other ones that are non-TD ones as well, and some of them are better, but for the most part, they will still have a couple of those stocks which are 5-10 billion. Those are specifically the small cap ones, not the small mid caps. So you still have drift, but even further, if you want to look past just small cap ETFs or funds, some thematic funds that are just absolutely awful as well, is you need to look at the holdings. They advertise it as whatever theme, whether it's like AI or something, but then they have something else completely arbitrary in there, and it might be 10% of their holdings. And I see that time and time again with these specialty funds.
Oh, yeah, they have a stock that we have looked at extensively, and they're included as whether it's a tech fund, and we don't consider that stock tech at all. It may have tech in their name, but often they're not what we consider that type of business, and you see that quite often. So you have to actually look at what you're holding if you really want to. If you really want
I agree with that.
Gain exposure to some of these themes.
I agree with that exactly. Just last point, just the amount of, people that I'll talk to and they'll say, I'm in this fund, and it's like, I'm just in this fund. I don't know what's in it. As an investor, you should just be you can quickly Google the fund and it'll show all of the holdings. So, you can know if you're in Apple, et cetera, any stock that's actually in that fund. So, I think that is always a good practice if, your advisor or whoever is, placing you in these mutual funds or ETFs, to understand exactly what is in that fund itself.
Yeah, and they should be able to have someone they trust, so they don't always have to do that and look at every single company. I mean, if you want to do it, for sure, but like in this case, if they're put in this fund by someone they trust because it is their option in the small cap segment, again, we just went through it. The top 10 holdings are definitely not small caps, so a significant portion of this fund is not small caps. So strange, and not a good way to gain exposure to that segment.